Good afternoon, good morning, or good evening, depending on where you are, and welcome to the opening event for the Governance, Risk and Regulation Center at the LIBF in cooperation with Risk Coalition. My name is Nathalie Schoon. I'll be your host today, and with me are Marcia Kanter-Grebel, who is an independent NED with a background in risk, corporate finance, investment banking, and insurance. Brian Vos from Risk Coalition, who is a experienced NED with extensive background in risk, regulatory compliance, and IT in financial services, and Olivier Béraud, who is a visiting professor at LIBF with broad experience in banking and rating agencies. We are first going to hear from Hanif, who will tell us a little bit more about Risk Coalition.
Great, thank you very much, Natalie, and welcome everyone to our webinar today. First of all, I'd like to say I'm absolutely delighted as one of the co-founders of the Risk Coalition to have this partnership with the Centre for Governance, Risk and Regulation at the London Institute of Banking and Finance. I think our objectives and ambitions are actually very similar, and I think we make a very natural partnership. And today's webinar is, if you like, the first event that we're holding jointly. As I say, I'm very pleased to be able to do this. I'd just like to spend a moment telling you a little bit about the Risk Coalition. Really, we started the Risk Coalition about 4 years ago. The genesis was 4 years ago when we started talking about the concept. The reason we kind of got the Risk Coalition going is there's a lot of information around and guidance around for boards, for example, from the FRC and their Corporate Governance Code, for internal audit through the Chartered Institute of Internal Auditors and their guidance. But what we found was actually with risk committees and risk functions, there's actually not anything really out there in relation to good practice principles and guidance. So we set up a project team and developed some guidance. The objectives were really several-fold. One was really to try and develop a common understanding of risk functions and risk committees. What we found in our outreach was that a lot of organizations were approaching setting up their risk committees and risk functions in different ways. One of my contacts I was chatting to was saying when he left his organization, a big insurer, the PRA interviewed him and asked him what he felt was missing most of all. And he said, actually, a lot of risk functions do very different things, and to actually work out what we do and to have a common purpose was actually really important. So in a way, I think we have set ourselves up to try and address that goal. And I guess with what we've done is produce a benchmark for firms to be able to self-assess against an objective standard about what good looks like. And really what we are doing as well is trying to raise expectations through webinars like this and the very many other events and webinars and publications that we've done. Members of the Risk Coalition are generally not-for-profit bodies, membership bodies and professional organizations, obviously LIBF being preeminent amongst them. Others include the Centre for Studies in Financial Innovation, Institute of Faculty of Actuaries, the ACCA, Institute of Directors, and many others. We've had very good regulatory support from the FRC, from the PRA, and indeed from the FCA. The FCA have very kindly given us a quote we can use in connection with our work. And what they say is they very much welcome the work that we've done to raise standards in risk oversight. They say that our approach and the guidance that we've prepared complements the personal accountability that they see as a very important objective. So I think we are getting some very good traction with our work and very much look forward to our partnership with the centre. So I'll leave it there and hand back to Natalie. What I will do is put into the chat a link to the guidance, and please feel free to contact me via LinkedIn if you want to find out a little bit more about the Risk Coalition. Thank you, Natalie.
You're welcome. And as for the link to the guidance, Brian's already beat you to it. He's already put that in.
Brian's always very quick off the mark.
Yeah, he was typing it as you spoke. Olivier, would you like to say a little bit about the Centre for those who are new to this?
Well, very briefly then, before we get into the meat of this webinar today. So as Hani very kindly said, we have set up a Centre for Governance, Risk and Regulation at the London Institute of Banking and Finance. It is a centre really that is there for thought leadership and trying to bring fresh ideas and content to our community, and also to offer training to boards and senior managers, and connect with a lot of qualifications also that LIBF already offers to people around the world, either in their professional capacity or to students in our university. So it's complementing, it's doing something that LIBF has been doing, I think, more or less for 140 years, but making it join up also with our two sister centers, which are the Center for Digital Finance and the Center for Sustainable Finance. So the three of centers together, I think, can really provide a lot of support, training, and as I said, thought leadership for the LIBF and the community. So that's all I'd say for now. And hopefully, if you are curious, again, you can contact me via LinkedIn or via LIBF directly. Thank you.
Thank you, Olivier. Now, this webinar kind of follows from the previous talk that was organized a couple of weeks ago with the title, "What Keeps Bankers Awake at Night?" And it was very much looking at what keeps people awake at night at the moment, in the very near future. And what we're trying to focus on today is looking more at what should keep us awake in the more medium-term future almost. What are the things that we can see emerging amongst ourselves that are going to come up? And there's all these things about the known knowns and the known unknowns and all these things that I trip over. But let's just start with the first question that I have for the panelists is, what are the emerging risks that you are seeing and that we should be worried about? And I would like to start asking Marcia for her response.
Well, thank you, Natalie, and hello to everyone on this call. I am going to start with just talking about some risk, a specific risk that you would all know, and I think that that's what's happening now that is so different. Many firms will have uncovered new vulnerabilities linked to whether it's the pandemic, large-scale remote working, the confluence of, in the UK, the separation from the EU, and I use that very deliberately, as you'll see from my remarks, as opposed to Brexit, and climate change. And what I want to center on is the way organizations function. So matrix management, you'll say, that's not a new risk. No, it isn't. But it is something that has been in place for a while, except that within the context within which we're operating now, it is shifting its shape. And I think this isn't the only matter about organizations that is shape shifting. And it's not just that it is shifting, it is the speed with which it's happening. Let me give you two examples. So matrix management and matrix organizations. I'm going to make remarks here from a firm perspective. I'm not applying the lens of a client or of the market or of the employee, just specifically the firm. So let's talk about one of these items in business models. Transfer pricing. You'll say transfer pricing. That's something that's discussed in audit committees and barely mentioned. And it's a nuisance when it pops up on the income statement as a surprise. Well, I think now actually it's gone deeper and faster, understanding where business is originated, where it's booked. Not in the way that had been discussed before. This takes on massive dimensions on risk and organization structure. So we're talking about origination versus booking on P&L versus remuneration, on capital and liquidity consumption versus, say, reward. You're looking at it by business line, by location, by legal entity, by regulatory remit. And that's before we talk about anything else, as I said earlier, with client and what the client needs and other stakeholders. the level of discussion and debate and insight because of vulnerabilities that have been discovered and gaps, all of a sudden causes firms to start to realize that they are exposed to certain risks they were so sure that they weren't, or that they had boxed in a certain way. Another example would be areas of expertise. This has become hypercritical, not just because of the interconnectivity, but if you look at what's happened during the pandemic, with the amount of fraud within the financial services market, it has become crystal clear to firms where they don't have the technology expertise or the information security expertise, and it sits one place in an organization or it's spread around. There are different ways to organize that, to look at a firm end to end so that they know they have their exposure, their enterprise-wide resilience boxed. And, you know, it's not just the COVID impacts on established controls. It's other things like identifying access management. But again, before you would see these things showing up in an audit committee, the annoying thing of, oh yes, we didn't cut off somebody's access, or we didn't permit somebody's access. Well, guess what? This is what we've now seen have been allowed so many inroads in the cyber attacks that have occurred. So it is elevated things previously that might have been a data point, a footnote, cursory discussion, and exploded open exposures to risks. I could go on, but I'm going to stop right there because I do think there's more to come on this perhaps later in our discussion.
Thank you, Marcia. That's very interesting. I particularly like the access management one because we all know full well that gets often forgotten, right? And there is definitely fraud, especially now that we are all working from home. Brian.
Hi, everybody, and thanks for inviting me today. Listening to Marcia, you can hear very clearly there's a lot of technical depth to a lot of the risks that banks face. But that has meant that the board has often not engaged well with risk because it's been seen as an over-technical topic. And of course, there are deep skills underneath these issues that need to be in place to address them. But the board is seeing now that risk is not about being negative. It's about being positive. It's about getting confidence that you can get to where not just you want to get, but where you've committed to your stakeholders to get. So you've set out your purpose, your strategy, and your objectives to investors, to employees, to clients. Are you going to get there? And perhaps in the past, you weren't held to account in the same way, but you will be now. If you're making commitments about zero carbon within 5 years, there's no second chance. If you don't do something pretty quick and pretty definite, you won't have a second chance to deliver to your accountability. So risk is about assurance of getting where you need to be. And all the things that were mentioned here underlie that. So what's most important? Well, most important is to have that clarity of purpose, to share it with your stakeholders, to get their views on your strengths and weaknesses, which they may not call risks, but which will help you understand the ecosystem you sustain your business within. And a big part of that, of course, is our clients. So clients are going through Brexit, they're going through COVID, and they've been replanning on a short, long, and medium-term basis. And I say it in that order because short-term could have been about survival for some of them, could have been about doubling their growth for others. Long-term was about a completely changed business model, probably much more digital, where things happen much faster and risks emerge much more quickly than you would have expected them to in the past. Medium term, because we're not quite sure how long this bit in the middle is going to go on for, where you have to sustain your business, but also start to build that new business model and get there before some of your competitors do, because it won't just happen by chance, it happens because you make it happen. So are your clients spending time with you, thinking about that being good use of time, and with you being part of the solution rather than being part of the problem. So are you offering the relationships that they expect at tough times? Are you being difficult to deal with? Are you offering easy to deal with low-cost execution in support of those relationships? And how do you know which risks are emerging for the marketplace as a whole and those which will address you particularly? Now, one of the things we found from our gap analysis is that 76% of independent board members believe that much more time needs to be spent on these emerging risks. After the crash in 2008, banks spent the majority of their time on current risks rather than emerging. But today, it's not 2008. Banks are strong, but clients and the markets are weaker and need our help. And we need to focus more of our time on emerging risks as digital changes things faster, and less as a proportion, but not less necessarily, on the current risk we see in front of us. To do that, we have to involve more frontline staff, more stakeholders, and we have to plan in a different way. So plan more frequently, have a faster business cycle, and probably separate the risk committee work to give it its own time away from board meetings and others. Perhaps a good model to think about this is that the Carrier Task Force is on its way from the UK across the globe on a training exercise. Now, without partners to work with, it probably can't see beyond the horizon, but you need to. And with our stakeholders in our ecosystem and with our purpose in mind, we can do that. And we have to live with a better understanding and faster response to those emerging risks than we ever have in the past.
Thank you, Brian. And it's quite interesting. You specifically actually draw out that risks are emerging faster than they did before. It's something that also resonates with what Marcia said, and what we definitely see in practice. Olivier.
Well, thank you, Natalie. And listening very intently to Marcia's perspective from very much the firm and how the firm is organized and how the firm can respond to these new emerging risks, and listen to Brian and his perspective at the board and how is the board attacking, culturally receptive to looking at risks. So I've been thinking about your question, which you were kind enough to share with us in advance in terms of what worrying us, and I've got a long list here, but I'll try to sort of bunch them together and link them to what Marcia and Brian have also said. I think the elephant in the room is, the pandemic is here. We know that it's a risk now. It's no longer a risk, it's an event. And I don't know how strong the rebound will actually be. I mean, there's lots of signs that we just don't know that. We have a number of things that are getting in the way. We don't know how much the separation from, in the UK, for example, how much the separation from the EU is being masked or is masking the pandemic is masking the risks that are emerging from the separation from the EU. We have issues about having enough people to drive the lorries of things that are being delivered, and how the supply chain and the logistical chains are affected by this. There's an element of vaccination. We are going through very intense periods of vaccination in the West. We can see what's going on in South Africa, which is a country where I do a lot of work, and this is unexpected. This is we knew that there would be pressure. We knew, but then there's a combination with another event that creates a risk that is accentuating the impact of the pandemic and the ability to rebound from it. Because I think embedded into our current assumptions is a very strong rebound from a number of economies, and I worry that this may not be as obvious as it is taken to be at the moment. And a similar thing is, the level of interest rates today. I see this both from a macroeconomic and professional perspective, but also my children are looking at potentially putting the first step on the property ladder, and the issue of rising interest rate, how quickly will they rise, and then will we keep control on inflation? I mean, is inflation coming back? Are we having to just go back to our old economics books, or do we have to reinvent economics as a science? Does it actually still work with zero interest rates there forever? And of course, we all know about the very high levels of sovereign debt, which is our debt. Who will actually repay that debt? This is something that I don't really completely understand, of course, like I think many other people, but is potentially having an impact not only on economic behavior but also on consumption behavior from people around the world, which again could feed into the first two topics I mentioned. Going back to vaccination, I sometimes wake up in the middle of the night thinking, what if a new variant comes in and puts us back right on the first starting point? Is this a game of snakes and ladders? Are we actually just being optimistic that we can actually do anything about this? And what would happen if that were the case to, again, morale and behaviors? To be more specific then to what that means for banks, and I'm sure you'll ask us something about this later on, but one thing I'm struck with is that we are starting to hear banks talking about paying dividends again, and I think we all agree that the other shoe hasn't dropped yet. We know that a lot of firms have been kept afloat. There have been fewer bankruptcies in 2020, 2021 so far than there are in a normal year. So would a return to normal mean that bankruptcies start to accelerate beyond even what we would expect after the effect of the pandemic, because there's a catch-up effect? Or on the contrary, will these firms, were they saved for good by the support from the state? How quickly is that support going to be able to be withdrawn? And so in the UK, for example, we know that a lot of loans were made with very loose underwriting criteria, and I'm not sure that all these loans will be repaid. And if even if there's any hope that we can have a proper assessment today. So that's clearly an known unknown, perhaps, or there may be even a few unknown unknowns. And the final one, I want to mention, because it's everywhere in the world I inhabit, is this sort of cryptocurrency. Fairly, we have a sort of a relationship with cryptocurrency, and which is sort of both one of misunderstanding, deep suspicion, because it's seen to be a sort of a bit of a dark art. But at the same time, I'm also thinking about will banks be even needed for any of the services that we use them for today? I mean, could Apple replace my bank? Frankly, I know that I'm trying to advertise for one particular company here, but I'd quite like my bank to Apple me in the next few years. Apple did lots of nice things to me in terms of my consumption of music and all my entertainment. I can't say my bank has delighted me in the same way as Apple has in the last few years. And so, I can now pay with Apple. I could do a lot more things, and I would perhaps trust them more with my data, dare I say, than etc., etc. So, there's all these aspects of how will bank react to the introduction? Facebook tried and was sort of repelled, but are they really given up? And what is that going to mean for the banks that are today our customers and our clients? Anyway, I'll stop there, but you can see there are lots of things keeping me up at night, but I'm an optimistic kind of guy. So I'm still hoping that we're going to get through this.
Thank you, Olivier. So I would quite like my bank to treat me like a person, but never mind the way Apple does. Anyhow, thank you all three for your views. I mean, there's a couple of things that I actually noted that I think are definitely worthwhile further investigation. The shifting shape of management, the environment of the banks, the increase of speed with which risks emerge. And then I'm very well in agreement with you, Olivier, as well. I think the pandemic is going to get the blame for everything globally, not even for things that it has nothing to do with. And I think we have to be very careful with that. Now, on that note, we've constructed a poll beforehand for the audience, and what we would like you to do is have a look at the poll, fill it in. I will give you a fairly running commentary on what we can see happening. If you choose, it's a multiple choice poll, so you can choose more than one. Thank you for putting the poll up. You can choose more than one, and you can choose other. And if you choose other, can you please put your comment in the chat box? Questions are coming in, answers are coming in rather. See a combined impact of Brexit and COVID. I'm still calling it Brexit, but it's the divorce from the EU, or the separation seems to be a big one. A lot of people check fintech may overlook the need for face-to-face is actually more than I thought. Changing demographics is not something that's particularly worrying to most of our audience. There's some very interesting points coming in the chat box as well. The long-term effect on household debt, that's a really good one, because that's, you know, that goes back to what Olivier said about the sovereign debt. I think it was Olivier. Dependence on legacy IT systems. That keeps us all in a job, but some of us keep that in a job. Right. And we have 74% of the votes are in. Being dependent on government decision against your own job. That's and the ability to safely accelerate tech transformation. So with 76% of the votes in, are you just going to leave it a little bit open, a little bit longer? Climate change, we didn't put that up because climate change, I think, is actually a current concern just as much as a future concern. Older generation to use technology to do banking. Yeah. My mother is particularly one on that one, because she doesn't like using technology, because she doesn't understand it, and the bank charges her for everything.
Yes, I think that's a really interesting point. There's a sort of lack of recognition of who your real customers are in terms of who's got the money, who needs the banking services, and not catering for their needs. I would agree with that. That's a very good point.
Yeah, absolutely. I think I see that as folks on fintech overlooking the need of face-to-face banking. And I think it's an interesting point, because as the whole idea with Metro Bank, no matter what their situation might be in some areas, they became very popular very sudden, because, you know, people actually like being able to discuss their challenge with something. Right. So the most of the votes went to the combined impact of the separation from the EU and COVID. Now, this is obviously a very EU-based response, because I'm guessing that would keep people elsewhere in the world probably less awake than in this area. However, it is something that is definitely, we don't know what the impact of the combined issue will be. Hacking and digitalization comes up. There's a lot of fintech related items that are actually coming up in the commentary. Brian, would you like to say something about that, as it's kind of like your area of expertise?
Well, it's certainly something that comes up quite regularly. And when we were developing the guidance, we were asked to validate it against each of these risks to ensure that the more general principle-based guidance could be deployed against, for example, technology transformation, but also against some of these others like geopolitical risk, which we've now worked through. And we have a working group on embedding sustainability as well. So technology transformation, what we're seeing there is that people are needing to accelerate what they're doing. And they don't necessarily have the skills to do this. They don't necessarily have the historic experience of being able to develop the innovation themselves. So there's a lot of mergers and acquisitions going on where firms are either buying some level of technology or even trying to reinvent themselves with technology. And there's some good global case studies like Walmart who are doing this, and some academic as well as practical M&A work on this. Right at the moment, I think if you talk to the Big Four, they'd say their M&A teams are sold out on technology acquisitions. And of course, some of those are for investment, but many of them are for transformation. And this is the issue I think we're faced with here. How can we safely accelerate the transformation to digital without causing bigger resilience or client risks or even regulatory risks? How can we be sure that we're still trading next week, that we haven't shut ourselves down by accident or exposed ourselves to cyber or other attacks? Because resilience is as important to the regulators and to our clients as the innovation technology transformation is. The board has a big role to play in this as well. And one of the things I've seen is that board oversight doesn't keep up with this very well. So, for example, you may be tracking revenues, maybe tracking profit. You might not be tracking which is coming through which channel and how exposed that is to different types of risk, so that risks can creep up on you. The numbers at the top stay the same, but what's happening underneath has changed substantially. And suddenly, the frog gets boiled alive. So I think it's important that we sort of refocus our efforts on this. But coming back to my original point, we need to do it not as a response to risks, but driven by our purpose and strategy, and the change in our business model to what it needs to be in the longer term, and how much of that we can achieve in the medium term while we're still faced with Brexit, COVID, and other issues that Olivier spoke about.
Thank you, Brian. This is quite interesting because I'm just looking at the final poll results. All the other ones we had identified previously get about 35 to 40% of responses. The only thing that people are least worried, the thing that people are least worried about is changing demographics. Marcia, I saw you and you know, your comment earlier on the shifting shape of management fits in quite nicely with what Brian just said.
Yeah. So I think if you listen to everything that Brian just said, he is talking about taxonomies of risk categories, let's just say, that everybody should be familiar with. What he's also saying is things have been changing because of the environment we're operating in. And many of the comments that Olivier made show how the dimensions of these existing risks, or I'll just say the categories of risk, have changed to cause worry. My point is the speed with which that is happening is unlike anything we've ever seen before. And I would just say to everybody, have another look, to be polite about it. You'll be amazed at what you find. The vulnerabilities that have been exposed around information security, cyber protections, cyber attacks is incalculable. It really is. The connectivity around the world and the implications for infrastructure and flows of funds and business is considerable. Now, and I've seen that discussed more and more at boards with not only at a big picture level, but at a level of granularity that takes time away from boards in special sessions to make sure that it's understood and bottomed out. I mentioned matrix management before because however an organization is set up, or however leaders are aligned to a legal entity or location, that cannot be the reason to get in the way of what's best for the client. So I made my comments starting from a firm perspective. Interesting perspective that develops when you totally flip it and say, oh, let's talk about it from the client perspective. And then on that basis, decide, gee, are there certain levels of expertise, like on cyber, they need to be centralized through our headquarters and spread around the world and leveraged. Let's not get hung up where the regulator is saying, no, you've got to have all those resources locally. Really? Explain, have the debate with them, show them why you need to be in it together. No crook, no bad actor out there thinks in terms of legal entity, do they? They think in terms of vulnerability. So I would just say to everybody to have another look. The other thing I just wanted to comment, I was surprised about the demographics. And the reason I was is I have a concern about a baby bust. What happens when there's stress and strain financially? You know, I think you could see that throughout history. You'll have baby busts, and then we don't have the resources. That may be a bit longer term, medium to longer term, but in the more immediate term, I think because of what we've encountered with separation from Europe, and it's not just in Europe, it's happening in the country of my birth in the United States. Visa restrictions, immigration changes have actually caused a dearth of skill sets across certain fields of expertise that are required. And you see it all over where people are saying we're having attrition. It's regretted attrition, and we cannot replace these people, and the costs are going up. So the competition is fierce. And I'll leave it at that. I think there's a real challenge for leadership and HR being a business partner in a way it never has before.
It's quite interesting because some of the comments that I saw in the chat box they're not necessarily related to them changing. They're related to changing demographics, but they talk about things like the change in demographics in combination with technology use. The fact that people are getting older, can they still use technology? But also, I saw a couple of remarks saying lack of experience at management level, lack of experienced bankers, loss of traditional credit analysis skills, which are coming in there as well. And I see it myself as well in banks that they let go of a lot of people where I think, well, you really should rethink that.
Interesting, Natalie. I wonder if I could come in to give a sort of a testimony from the front line of training and engaging with. There's a bit of an echo. Maybe you could unmute. Thank you. That's very kind. We've recently delivered a training program in Malaysia to a number of quite senior bankers, and there was a technical part where we talked about all the usual things, and then there was a sort of more leadership part where we talked about how to deal with the crisis. And one of the interviews we had with one of the CEOs there, I think it was Standard Chartered CEO in Malaysia, he came up with this wonderful expression. He said, during the pandemic, he realized he was an incomplete leader. I mean, he knew that in terms of, of course, I need to show vulnerability and all that, all the things you hear about and all the sort of nice talk you hear. But he said during the pandemic, he realized that, it wasn't just a question of saying, you are surrounded by people who know more than you do. It was a question of survival. You had to trust the IT guys. You had to trust the people who did things for him to just do them and then report back. And I guess for the first time, he, like many others, experienced that true delegation wherever they happened to be. I mean, they were all in Malaysia, but actually, they could have been anywhere in the world. Suddenly it was matrix management in a way that, Marcia is talking about within Malaysia. It was no longer, and I'm sure that's true in France and it's true everywhere, because people were not in the office and he couldn't control what they were doing, and he had to trust them in a way that, of course, he trusted them, but this time he couldn't actually check anything that they were doing before they did it. They had to do it very quickly, and they had to implement all these things in order to enable the bank to function. And increasingly we're seeing demand for leadership training that has to do with the ability to inspire people, but also make sure that you can trust people. How do you check? It's a cultural issue. There are things that managers are not and boards either are not necessarily majoring on, we talk about control, we talk, there's a question about statistics, how do you and in many ways statistics will tell you what happened in the past, but they're not telling you what's happening right now and how your business is being impacted by the crisis. And so there's an element of dislocation and an element of fragmentation there that relies more and more on this matrix management idea, which then gets in the way of borders, be they national borders or silos, or and all this is creaking. The machine is sort of showing signs of not being adapted to the new task.
That's a very interesting point, Olivier. And there's two questions from the audience that are coming in with that. What are the views on the use of statistics in assessing risk? Now, I know what my views are, and I think they're very useful, but they're not necessarily something that always give the, they can be manipulated to give the results we would like. And learning and development. So you're mentioning it just now. A lot of institutions have the idea that if you train people, they will leave. And that then comes back to not having sufficient management, or they will go for another job. Is that the question? Is that an answer? Is it more training, or is it just acquiring more better experienced staff in the first place?
Of course, I would say that, but I expect that firms that provide ongoing training for very long careers of people who are going to shift and change it, whether they like it or not. In fact, as we said, you may have a desire to change what you do after 10, 12 years or whatever, however long maybe 2 years for the younger generation. But in any event, your job will change dramatically whether you like it or not. So ongoing training is a firm that doesn't do this wouldn't be able to retain many people I know anyway. So I think that old question about whether you train people and then they leave, well, that might be a sign that you're already treading water, frankly, but I don't want to be too harsh.
I'm minded to agree with you. Training staff is a good thing, and there's ways to manage it by making sure there's ways to manage to make sure that they're staying. Anyhow, if we just go back to the issues that are earlier mentioned, I would particularly like to come back to something that was said about the environment of the financial institutions operate in. So we're not really, financial institutions do have a tendency to look at themselves as, this is my risk and this is what it is. But how about the environment we operate in? Brian, would you like to give that a start?
Sorry, the environment we operate within.
As in stakeholders. If we start paying dividends, for example, as has been announced, do we alienate other parts of the business?
Well, there's a big discussion underway about this at the moment, and it's also part of the BEIS consultation, which is just closed. If you have any comments, you've missed your opportunity. But of course, the board needs to be very well aware of the business model and how much cash and value it's producing and how that's shared out, whether it's paid out in dividends, whether it's paid out in bonuses, etc., for staff, or whether it's reinvested in the business. And a lot of businesses don't have, at the board level, that strong view of the business model sufficient to be paying the right amounts in each of the directions and to justify it. Now, during the COVID crisis, the banks have looked more closely at the way the clients run these business models, because they don't want to be lending their clients money when the clients are paying money out in dividends or bonuses. They want to see it reinvested in the business in tough times. So that argument is very much front of mind at the moment. And I think it's one which will result in boards maturing their capabilities to understand their business model, how much money is in the business, and how best it to be used. And I think it's a bit of a distraction, really, to just talk about bonuses or just talk about dividends in isolation. I think we need to look at the sources and uses of cash for the whole business.
Marcia, any views?
Not so much to add to what Brian has said. I was, if it's okay, I was looking at some of the questions on the side, and I wasn't sure that we had actually addressed Charlotte's question about the use of statistics in assessing risk. Now, I have to admit, if this is Charlotte that I know, then I know Charlotte. It's a great question to continually ask the management, whether it's finance or it's risk teams and it's compliance, given the areas that a firm is operating in. How do we know that our statistical measures are still appropriate and relevant? And I think that when you look at the environment we're operating in, we've always been operating to a context of at least annually you're doing a complete bottoms-up review for capital and liquidity, and you keep sufficient resources in place at all times. I think there's a real question, though, given the speed of the way things are shifting, and as Olivier has said, they have not settled yet. To constantly be alive to the need to reassess how you quantify and track your risks. So I go back to where I started. You think you know everything, don't assume it. Take another look, because the world has changed. And I think, Brian's comments also validate that or support that.
And it creeps up on you, right?
Yes, it does.
Because one moment you think everything's going swimmingly, and the next you're looking at things and thinking, hold on, what did I miss?
Yeah.
And as you said, Natalie, oftentimes it's old risks that are coming back to bite you that you thought you'd dealt with, right? I mean, credit is one example, and a lot of people were, very competent and very well trained after the 2007 and 8 crisis in how to deal with non-performing loans and restructuring companies. A lot of these people have moved on. Some of them have retired, and we don't have the same bench strength in those skill sets that we used to, and we will need them again. So there'll be plenty of people having to come from different areas to tackle with this. And if I may, Natalie, I mean, in terms of impact and in terms of the things we mentioned before, and Brian and Marcia mentioned, one thing on the demographics and the fragmentation is the fact that we can see now how inequalities will continue to grow. So inequalities in the face of vaccination, inequalities in the face of how quickly you can rebound from the pandemic, inequalities in the effect that the pandemic has had, and the starting point that you are now starting from because of the impact of the pandemic. And there's a sort of worry about the state being already very solicited and very invested, and how much the state can continue, the states, the governments can continue to support the weakest in society. And we have seen the impact of these. I mean, it's a bit early to comment on South Africa, but clearly it's the first example of a combination of, other events that are specific to South Africa, but also, a sort of desperation born out of the impact of the pandemic and other things. So, that aspect of inequality, and sorry, I should have mentioned, of course, the final type of inequality, which is the inequality in the face of the changes that you're talking about, the speed of changes, the digital nature of our society that is not, enabling everyone to participate in the same way. So these inequalities, without making a political point at all, I simply, I know that in economics or in business, when you have inequalities, you have opportunities. You have enthusiasm and energies for people who want to do better, but you also have frustration, and you have to behave and believe in the fact that if you follow the rules, you will succeed. And so the compliance and cybercrime are two facets of this thing. And you have to realize that if it's easier to come and help yourself via a sort of very easy crime, which is cybercrime, and then move on and no one can ever find you, that has an impact on compliance and impact on behaviors. And just to remind you, this year's banana skin survey on banking by the CSFI, which is another of our partners, came up with crime, not cybercrime, but crime, financial crime, as its top position for what people are worried about in banking. And I think this is not just because cyber is, but there's a whole societal, cultural thing about it that is quite concerning.
Olivier, this is a good example, I think, because one of the points I wanted to emphasize is that we look at our firms almost as if they're independent in the market. We don't look at them sufficiently in a way which represents that the business model runs across value chains. May include distributors and support organizations. And when these problems need to be first identified and then tackled, it's much more effective if we can do it with others. So, for example, if you look at the Maersk cyber issue, the reason they survived it was because all their business partners clustered around and helped them. In many other cases, the people you're dealing with will run away and leave you with the problem. Now, if you've been very clear about your purpose, about your ethics, about your efforts, then you're more likely to achieve the first than the second. And just as a cross-sector example as well, if you look at what the FCA are doing with their sandbox, they don't tend to support competitive initiatives for individual companies. They tend to support initiatives which lift all boats. So if you look at their work on innovation, it's around things like vulnerable customers, around AML, things which will move and improve the whole sector. And those are all good things to be supportive of and included within, because they will reduce risks for not just the banking sector, but society as a whole, which is a good thing. So
lest we be completely depressed by the topics here, I know that there are some people that are participants in this. I'm not going to call them out, but they're from organizations or firms where we know they have hundreds of people inside the organizations that attack themselves every single day. And there are many firms that have that, and we should be grateful for that. It's a good thing they don't talk about it, other than to the people that really need to know, because, as I said, those that are ill-intended don't place any stock in confidentiality or anything like that in order to achieve their gains. But to Brian's point, the need to understand your business model end to end, where you have expertise in pockets that you can leverage, and you really refine exactly how you use that. You understand who your business partners are, you understand what they can do and their vulnerabilities with you. It makes all the world of difference in being able to sleep at night. And so there are many things that are going on that most people in vast populations don't know about. And, and that's the underpinnings of the financial markets infrastructures, whether, they're exchanges, clearing houses, payment systems. These are things I actually don't like talking about, because unfortunately, those who are otherwise inclined to do harm to them are fully aware of their existence. But there are firms that attack themselves every day to keep us all safe. Thank goodness.
Indeed, thank goodness. Now remarkably, we have only 5 minutes left. So what I would like to do is just reiterate something that Brian kindly put in the chat box. If there's any questions, we will continue this discussion and we'll produce a podcast for that will be made available. Because there have been really very good comments in the chats, and we would really like to see if we can address as many as possible. What I would like to end with is a positive note, right? So what are the positive things that we can see are likely to happen to manage these risks, to make sure that we're all okay? Can I start with you, Olivier?
Sure. So I'm glad you're giving me a chance to do this, because I've been very gloomy, and it's not in my habit. But I think the pandemic has showed us that if we want to, we can really react and do a lot of fantastic things against the common enemy very quickly. And I think that shows, human ingenuity and resourcefulness. I mean, I was struck by stories of, people in various aspects of research and science giving up their projects to focus on solving the issue of finding a vaccine, for example, and that was done in a record time. So, I think it's a question of willingness, not of capability. I mean, some things, of course, are tricky, and I'm not sure we can resolve the environmental crisis just because we want to. Clearly that's not what I'm trying to say. But I think by getting our strengths together and working in an aligned fashion, we can actually do a lot of things. And inclusion in particular, to end on a specifically positive note on that, I think the digitalization of the financial industry is actually a fantastic opportunity for older and younger people. It's just that we have to think of our customers, our clients, just like Marcia was saying. We have to think of them and how we can help them to be more included into this revolution. And frankly, the opportunities to do more business for them are therefore infinite because of the potential that this provides us with. So I'd like to stop there, but I think that's a very positive message, hopefully.
Well, I agree, especially the one on what the pandemic has shown is that we actually can get together and get something done if we really want to. Brian, would you like to add something there?
I think the key final message is to go back and focus on risk as, for myself as a board director, I need the assurance that the commitments I'm making to stakeholders can be delivered. And I know things change quickly and emerging risks can appear and need response very quickly. But we also need to have some stability of approach. And we need to know what maturity we have today and where we're putting our resources to fill those gaps. And we need to be transparent with our stakeholders about that too, because they won't believe and trust us otherwise, and they won't stick with us. And so this is what we focused on with the Risk Coalition, to help people not just understand the principles and guidance for risk, but what's your maturity today? Where should you place your effort and budgets? And I think Olivier said a week ago, if a risk is unbudgeted, it's probably not a risk taken seriously. You're probably not moving towards it. You're probably going to be impacted by it. And there are probably too many of those risks, perhaps already known in your organization at the moment, which don't have the attention they deserve, which won't just set you off course, but they could completely undermine your purpose and your reputation with your stakeholders.
And Marcia.
So I would just like to say that if you go through all the information and the tools that have been provided by the Risk Coalition with an open mind and an open heart, you will have an opportunity to step back and look at the risks that you consider within your remit now, but in a different way. And I think it encourages that. And that is a good thing, because if there's one thing that we've seen because of the confluence of the pandemic, Brexit, climate change, more of a focus on D&I and ESG, is that there are more exogenous factors underway right now. And so you have to be alive to how it will impact a firm to survive. And I think that means different types of leadership, different types of board conversations. There are certain things that we will not be seeing anytime in the near future, 100% for all companies, all in the office. Hybrid working is a reality. So what does that mean? I would just encourage people to open their minds and their hearts to different ways of looking at what they think they already know.
That's a very nice point to end on. Thank you, Marcia. And it leaves me to thank you, panelists, Brian, Marcia, and Olivier, for your very interesting insights. And I would like to thank the audience for turning up today and for being actually proactive in providing us with additional comments. I hope you've enjoyed it, and hope to see you soon.